Hello, this is the Alhambra Investments Monthly Macro Monitor, and we've got things that we want to share with you today, not necessarily the normal report. And Joe Calhoun, I would call this the good, the bad, and the boring. And most of it's boring. We got a lot of stuff going nowhere right now.
Well, but you know what? Boring is not bad. I'm okay with boring. I don't think we want a lot of excitement going on with the economy and and our investments. I'm not sure we should call this monthly macro, Bob. It's been a while since we did one of these. We kind of got off track there, but that's okay. We'll get back on track with this one. Look, it's a lot of stuff is like this is kind of doing exactly what we said it was going to do, right? I mean, we won't break our arms patting ourselves on the back. But our thesis has been for a year now that we would slow down back to trend, that this stuff from the little boost that we got from the tax cuts would fade, and it has. And so here we are. We're right back to trend. And like you said, that's kind of boring because 2% growth is kind of boring. And like I said, that's okay. It's not terrible.
Well, you know, CFNAI is one of those reports that you put a lot of stock in, and that's confirming exactly what you're saying, is that we're moving back to trend.
Well, when you consider that the CFNAI is, 70 something different indicators all put together, it's a pretty broad measure. And when you consider that 0 is on trend and we're at 0.1, that's about as close as you can get. And I guess, we look at the 3-month moving average, which is also, I think, a minus 0.06 or something like that. So it's just right at trend. We're growing at 2%. Maybe 1.5 to 2, maybe a little bit more. But yeah, the CFNAI says we're right on trend, which is right where we expected to be.
Well, we're going to slide all the boring stuff off the table. There are 2 points that I want to hit within the report before we get to a couple of other things. Let's talk about the good first, the good news or the bad news. So okay. The good news is that housing is doing pretty well, which is, I don't know if it's a trend yet, but it's moving in a direction different than it has been for a long time now.
Well, I think there's been so many people emphasizing the negative and emphasizing the bad. I think it's wonderful to thinking about the good things. Look, we can't forget about this. Everybody wants to concentrate on the bad stuff, but there are good things going on in our economy, and it's not just housing. But we'll talk about that for a minute. Look, we've got new home sales are almost at a cycle high, not quite there, but housing starts and permits are at the highs for this cycle. They continue to drift higher. 6 months ago, 9 months ago, people were starting to fret about this. And when you look at housing, it has subtracted from GDP for a long time now, a couple of years. Now, every quarter, housing has subtracted. And this quarter and third quarter that we just finished up is probably going to be a positive. That's a pretty big change. People are very worried about manufacturing, but this is what happens in an economy. It's an ebb and a flow. And, we had housing not doing so well, and now it's starting to pick up the slack from the manufacturing stuff. That's just the way things work.
Do you think it has anything to do with the Fed dropping rates a couple of times?
Well, we can talk about the Fed doing it, but we can talk about the market doing it too. From when we're thinking about housing, we're really thinking about mortgage rates, thinking about those rates. Those are long-term rates. Fed doesn't set those. Now, Fed can influence them with short-term rates, obviously. But, long-term rates came down a long time before the Fed ever cut rates. So mortgage rates came down, or 10-year Treasury notes rates came down, and then you get mortgage rates down, and yes, it has an impact. How much of an impact? I don't know. I would point out too that housing inflation, the price rises have moderated quite a bit too. So it may be too that people's incomes are catching up, and the prices have moderated a little bit. Maybe it's a little bit more of a buyer's market than it was a seller's market a few months ago. And so there's a number of things that are working together there, but certainly rates are having an impact too.
Well, let's talk about something that's not quite as positive. That's core capital goods and inventories. Inventories are coming up against sales, and they're going to have to do something with all of that inventory. But then core capital goods, you're concerned about that one.
Well, we've been concerned about it for a while. Core capital goods orders aren't any higher now really than they were back in the late 90s in 1999, 2000. I mean, slightly higher. It's a fraction, just not that much. We've had this problem of investment the entire, really since the turn of the century. Yes, we've gotten back up near these peaks that we set back in '99, but we can't seem to get over them. We popped over it a little bit in this cycle, but not much. Core capital goods are a big deal because if we're not investing in capital goods, then we're not investing in the economy. It's going to be hard to get growth higher. That's the bottom line. And look, we see that, and we'll talk about this more, when we do our market indicators, but we see it in real interest rates. Real interest rates, less than a year ago, well, no, I guess right about a year ago, were about 1.2% of the 10-year real interest rate on the tips. Now you're at 0.2. We've dropped 100 basis points on real interest rates. Real interest rates are the intersection of savings and investment. And if you have investment, there's demand for funds, there's demand for activity, then you get a rise in real rates. And we haven't seen that at all. We've seen them fall. So we know what's going on with investment, and it's not positive. Housing investment is not quite the same thing. Yes, we're getting some investment in housing, but that doesn't provide the same productivity boost that you get from core capital goods.
One of the things that drove the ups and downs in the market this quarter was recession fears. And everybody's jumped on the bandwagon. They think they know what's going on when they talk about yield curve, which for many, many years has been one of our great indicators about the possibility of going into recession. But there was something in your report this time around that interested me. You mentioned a guy named Campbell Henry who actually created the look at the yield curve. And tell me what he's saying about it.
Well, it's Campbell Harvey.
Harvey, not Henry.
That's
sorry.
Okay. That's okay. Harvey, Henry, it's close enough. Campbell Harvey is a professor at Duke University. He wrote his thesis, his PhD thesis on the yield curve back in the 80s. So he's kind of the guy that's kind of the godfather of this stuff. He's the one that kind of really first recognized that the yield curve was such a great predictor of recession. And one of the things he's saying, and this is quite interesting to me too, because it's about psychology, and so much of what we deal with in economics, because we're dealing with people, we've talked about this many times, right? People want to reduce this to some kind of science. Yeah, not so much. It's about people, and you can't predict people's behavior, but we can kind of predict sometimes what they do, the way people act. So Campbell Harvey is saying, look, this widespread recognition of the yield curve being a good recession indicator, and the widespread knowledge that it has inverted, actually increases the probability that we'll get a soft landing. It's like, oh, wait a minute. That's kind of interesting. Why is that? Well, think about it. It's the same thing that you see in what we've talked about before. I know we've talked about it before, is George Soros's theory of reflexivity. The market is really the important thing here. You don't look at the economy to figure out the markets. You look at the markets to figure out the economy. Well, same thing here in a way. We see people acting in ways because they're aware that the yield curve is inverted, and they act in certain ways that changes the market, reduces interest rates, for instance. And that reaction function means that the economic reaction will be smaller than it was before. So the fact that everybody knows about it means that they prepare for it. They prepare for recession. They start doing things, and their actions create the conditions for the soft landing. I think that it's interesting. Whether it comes true or not is one of those things where, when you're growing at 2% or 1.5%, you're very vulnerable to a shock. So he may be right, and I hope he is, but it depends on there not being some external shock that knocks us into recession. Because when you're growing at 1.5%, it doesn't take any big shock to put us there.
Well, a lot of CEOs are already preparing for recession. So does that fit into his scenario?
Absolutely. The same thing. We look at Duke, go back to Duke University again. Duke University does these CFO surveys, Chief Financial Officer surveys, and over half of the CFOs out there believe there'll be a recession before the end of 2020, and a third of them think it'll start by the second quarter of 2020. Now, so what do? They start to act in ways to mitigate that recession, right? It's not sudden, as 2008 in a lot of ways was kind of sudden. It was more unexpected. I remember back in the summer of 2008, a lot of smart people were still saying that there was the possibility we would avoid recession. Well, we were already 9 months into it at the time. So when the real crisis hit in the fall of 2008, it was a bit of a surprise. And companies reacted very negatively and very quickly. They slashed jobs. They cut jobs. They cut people they probably didn't need to cut. They were just afraid. So the reverse happens now because everybody thinks there's a recession coming. They start to do things to mitigate that potential damage to their company. So right now, it doesn't mean laying off a bunch of people, but maybe it means you don't hire quite as many new people. And maybe that's what we've been seeing in the employment market. We've been seeing this all year long where the number of monthly jobs created has been falling. Well, maybe that's just companies starting to prepare for the recession. They're not hiring as many people. Again, maybe they're not going to fire a bunch of people, but maybe they just hire more slowly. Same thing with investment. Maybe they're not going to slash investment, but they may pull back a little bit and go, let's wait and see how this comes out before we do make some big commitment to a new project. So I think that their actions are starting to slow the economy. That's where we are. And it may be that their actions, prevent the recession in itself. We'll see.
Well, we've talked about the possibility of recession, and now then it's been, like you said, a little while since we've done one of these reports. What do the indicators you're looking at tell you about recession?
Yeah, we're not there yet. Just to put it really bluntly, we watch the yield curve, we watch credit spreads, CFNAI, leading indicators. We have our own internal system for looking at some other indicators. Everything is pointing to us growing at trend. Now, look, let's not be too sanguine here. The trend is down, okay? We are slowing. We have seen some evidence that the slowing may be ending, but nothing that is definitive. So I would just say that it appears that things are moving in the wrong direction. We'll see what happens to see if they start to bottom and then turn higher. We see that a little bit already. Just to use interest rates as an example. The 10-year Treasury note yield, nominal 10-year Treasury note yield bottomed at 140 something, 1.4 something. We're already back above 1.7. That rise in interest rates means something. It's not just that, people are selling bonds at random. They're selling bonds for a reason. They think rates have gone down as low as they're going to go, and then things are going to turn up. We see the same thing in the real interest rate phenomenon. What I said earlier, we've gone from 1.2 to 0.2, but we actually went negative for a while. We're 25 basis points off the low. So we've already seen interest rates react and start to move higher. We may have already seen the low of this slowdown, but I don't know that for sure. I would say that right now we just think that things are growing at trend and we're still slowing, and we'll see where we go from here. By the way, I think, a lot of this has been global because it's been trade oriented. And I would just point out too, that a lot of the stats that we follow in Europe, what we're seeing, and we've talked about this before, what we see when we get towards the end of a slowdown, we start to see the revisions turn positive. So they'll report a number, and then when they report the revision a month later, the revision is higher than the original number. We're seeing that in a lot of stats in Germany in particular right now. Japan is still looking, I still think looks pretty good. So we'll see how this goes. China's the wild card. We don't really know what happens in China, right? We know it's slowing. We know they've had some problems. We know because of trade, the trade volumes have been lower. We know there's some slowdown in China. We can't quantify it. So, like I said, it's kind of where we are. Maybe we've seen the low, maybe we haven't, but right now we're right around trend.
Well, the last question I've got for you today has to do with trade disruption and the deficit. And in your report, you said with all the trade disruption going on, deficit really hadn't changed.
Yeah. My goodness, a lot of things going on, a lot of people very upset, very, you would think that surely all the things that Donald Trump has done, he's imposed all these tariffs. My goodness, the trade deficit must have just gotten better. And it hadn't changed a bit. The composition of it changes. Listen, this is something we've talked about before too. Look, trade deficit is about the budget deficit. The budget deficit, as long as we're running $1 trillion deficit, you are not going to get a balanced trade account. It is not going to happen. So right now, the thing that's going in the wrong direction is the budget deficit. I don't see any change in that. And by the way, I don't think it matters who wins the election for that. I don't care who wins the election. We're going to be running a big deficit next year. So until you fix that problem, you're not going to fix the trade deficit. You're sure not going to fix it with tariffs. All you do is shift the deficit around. It goes to a different country. By the way, here's a little interesting thing that I saw. You look at the oil market, and I find this fascinating. The oil market, we had, at one point we were running close to a $300 billion or a little over a $300 billion annualized deficit in petroleum and petroleum products. It's a big number. That number's now down to about 30 billion. And yet, trade deficit's the same. Now, look, part of the reason for that is we're exporting more, obviously, and part of it is that we're importing less, but part of it is price, too. We've seen oil prices, compared to, say, a couple of years ago, are half what they were then. They were over $100. Now they're in the 50s. So part of it is price, but it just goes to show, I mean, even if you fix that was the biggest problem with our trade deficit. Everybody said, oh, if you fix this petroleum deficit, you can fix the trade deficit. Well, we fixed it. You still got a trade deficit because we still got a budget deficit. So until I see some plan out of some politician that spends less money and closes that gap, we're going to have a trade deficit. And I don't see anything from anybody on the campaign trail right now that is going to cut our deficit.
And that's a discussion we won't have about politics.
We don't like politics around here.
So any last words before we end today?
I just think that people need to calm down and look at where we are. Listen, our work right now says you need to be in a normal allocation. Whatever that normal allocation is for you, that's where you need to be right now. We don't have enough evidence to say you need to be shifting to something more conservative. We certainly don't have any evidence that you need to be shifting to something more aggressive. So wherever your normal allocation is supposed to be, that's where you ought to be until we get more evidence for a shift. Right now, there's no reason to make any tactical changes to your portfolio. You need to stick with what you got.
Don't follow the herd because the herd is generally wrong.
There you go.
All right, Joe, thanks.